l1p2 corporate reporting. Right. I believe you have made the right decision by choosing this paper before all the changes happened this year. I hope it's the right decision. And I believe most of you who chose this paper must have given up your P1 and P3 to take the one big paper with a wise choice. One paper is better than doing two papers. I agree with you. But this will not change. Whether you do now or do later, this paper is not going to change. Subject matter will be the same. Right? Paper can be different, but subject matter will be the same. So welcome to the class, and let's enjoy corporate reporting. Right? And I'll be doing this program for you for the next 19 lessons. Alright? And please take note. Before I start, let me introduce myself. For those who know me from other papers, welcome back. Let our relationship continue. Those who don't know me, that's my name. Alright? Please call me by the first half. Okay? And I will be taking all the 19 lessons for this paper. And the interesting thing about P2 is it is a very nice paper to do if you enjoy the subject matter here. And to enjoy the subject matter, you must love standards, right? The paper is fully built on standards, plus consolidation is heavily tested in this paper. So 80% of the paper relate to groups. So if you must like or love groups, and individual accounts coverage is very little in this paper because it's already done in F7. So this paper, foundation knowledge, comes from paper F7. Anybody exempted from F7 because you have a degree in accounting? Anybody? How many of you are exempted? Can you just put up your hand, please? In the back. Okay. If you have been exempted, that means you have done something on reporting, accounting standards and consolidation. You must have done something. If not, you will not be getting an exemption. So I believe that knowledge should be sufficient to carry you through. But if you have any problems along the way, please don't hesitate. Come and check with me and talk to me if you have a problem as you go through the course. All right? And I'd just like to see those who have been exempted after the lesson. All right? So that I can tell you exactly what to do. For those who just finished your F7, P2 is absolutely an easy paper to do. If you have completed F7, P2 is just a natural continuation from F7. Yes, please come in. Alright, so what you will see in this paper and so on, I can tell you. There's a lesson plan given to you. Please follow with all the dates. You belong to Group 1, the part-time class, which is the second part. You are given the schedule there. Please check. All the 19 lessons, what are we going to cover, is all planned out there. Alright? Two things I'd like to remind you before I start this paper. You are the first batch to go for there's no more SGP variant. Reporting only has international variant from this year. So what you're preparing for is the international variant. There's no more Singapore variant for any paper now. All the reporting papers, all the audit papers, everything only has international variant. Alright? So this paper, you are going to do the international variant, okay? There is no more Singapore variant, but things are the same, except that Singapore we call it FRS, international variant they call it IFRS. Numbers are the same, standard is the same, everything is the same. So nothing to be worried about, international variant, no issue. Second thing, for this batch, you are the last batch for this style of paper. Because from September 18, paper structure is going to change, style of the paper will be different, focus of testing will be different. Right? So you'll be the last batch to sit for the current syllabus. Whatever the new syllabus will be applicable from September 18. But you are preparing for the June 18 examination. So June 18 will be the last batch for this structure of the paper and syllabus which is given to you. Right? So June 18 is the last exam for corporate reporting. After June 18, this paper is going to be called Strategic Business Reporting. High sounding, but same thing. Right? ACC likes to put some high flown words inside to show that things are harder. But actually, the subject matter is similar. The focus of testing and the style of questions are going to change. That's what we were told. So in future, this paper after June 18 will be called SBR. The other paper is SBL. Alright? So this paper will become SBR from September 18, Strategic Business Reporting. You are the last batch to sit for corporate reporting. First batch for international, last batch for corporate reporting. Alright, so please finish it, because looking at the model exam paper in SBR, they are taking a lot of this emphasis on calculation out and putting more integrated reporting in the new syllabus. So the new syllabus was created to bring in more and more of integrated reporting. So it's going to be much tougher in the new paper, because writing is going to take a heavy loading. Already now in the current paper, writing is a lot. Calculation is very little. In the SBR, calculation will be reduced some more. But syllabus-wise, there isn't very much change. But the emphasis on testing, calculation will be reduced, interpretation and writing will be increased. So therefore, finish it now, put your heart and soul into it and complete it by this round. No more reporting paper after this. And also, when you finish a paper like this, the knowledge is applicable into all other reporting papers in any exam you sit, like ICAEW or the Singapore Accounting Body's examination. They use the same standards and same consoles. So the knowledge that you obtain will be very useful in any other qualification you want to pursue later. So please take it along and finish it nicely. My job is to give you a thorough knowledge over the next 19 lessons. And for that, alright, only two things I require from you. One is, please be regular to classes, because one topic links to the next one. That's how we program the whole lesson, alright? And also be consistent in your work. Don't keep until the last 1 month and try to cram everything. The brain will damage, understand? It's too much. Absolutely too much, especially console and standards are heavy in this paper, alright? And what you did in F7, for those who did F7, is only on the surface. So what you covered in F7 is all the basic things. This paper goes into advanced work. So it's actually reporting advanced level. So what you're going to cover here, I can tell you briefly. Alright, in F7 you did basic standards and basic groups. This is what you should have brought forward from your F7. If you're exempted, I hope you have some basic standard knowledge and basic groups knowledge. Alright, then the current paper, please take note, for this examination, the examiner for this paper has been there for very, very long. Alright, the examiner for this paper in UK is Graham Holt. Alright, Graham Holt has been the examiner now for nearly 40 years in ACCA. He's one of the longest serving examiners because he's a very good examiner. So don't worry, he will be there forever. Understand? So will he change? Will the structure of the paper change? These kind of questions are irrelevant because he's not going to change. ACCA will never change him because he's a very good examiner. Alright? And his questions are excellent and sometimes too good. Over the limit he sets questions. And this paper has got a lot of issue-based problems. It is not a pure calculation paper. It is an issue-based paper. When you say issue-based, they cover only 3 areas if you broadly classify the syllabus. One is, it covers accounting standards. First thing, you must be very good at all the standards which are available, plus new standards which are coming up. So what is examinable is current standards plus new developments or recent developments in the pipeline is also examinable. So please take note, you also need to know current issues. Current issues or recent development. And this is where they put all the new standards coming up inside the syllabus, please, by putting one word called recent developments. Exposure drafts, discussion papers, all are examinable in P2. Right? And some of them get examined even before it is implemented in Singapore or internationally. Then the next one is, third part of the testing in this paper is group accounts. And group accounts is advanced group, so you need to go into advanced consolidation. So we go into advanced consolidation, part 3 of the paper. Weightage in terms of calculation and writing is 65% of the paper. When you sit for the actual examination in June, 65% of the paper will be writing and analysis. Some people tell me it's an accounting paper and I never touch my calculator for very long. Understand? Why? It's all fully interpret, because you're taking a role, advisory role now. So you're no more sitting there and crunching numbers that you have people to do for you. So you put you at that level where you advise what is to be done. Based on right things to be done, you advise your staff what needs to be done. So it's writing and analysis. Wrong treatments, how to correct it. Standard applications, what is the right thing to do, all are done at this level. Then 35% of the paper, guaranteed every exam, is calculation. Where you prepare financial statements, consolidated financial statements carry 35%. So 35% of the paper is calculation. In the new SBR paper, they're going to reduce that calculation to 20%, writing to 80%. That is the proposal, and by September things will be finalized and you will know that the calculation part will be given lesser emphasis, please. Currently is 35. Guaranteed every exam, console carries 35 marks in your exam, a huge question. The remaining 65 are all issues in accounting related to standards, ethical issues and so on. Alright? And everything we do in this exam will be international variant. And what will we be covering? I'll just give you a brief outline today before we start, because I believe that you must know what is in the subject before you put your leg inside. So what will we be covering for the next few lessons? Let me just run through with you. And these are the key areas of the paper, please. The examiner breaks the standards into key standards and minor standards. He has his own way of looking at the important parts, which are key issues in reporting, alright? And key standards are examined every exam without fail. You spread it across the paper everywhere, alright? And this paper, we have to do the standards first. We can't do the consolidation first because all the consolidation comes with adjustments. Adjustments are related to standards. So standards are tested in two ways. They are tested together with console as adjustment. If you don't put as an adjustment, it will be under issues asking you to explain what is the right treatment, correcting wrong treatments. So, testing of key standards. What are the key areas? First, today we open with introduction. And under introduction, please follow. You need to know a little bit about the accounting framework. Questions are still set in P2 on accounting framework. This is the fundamental document for doing accounting, so they do not want to skip this. Framework is still examinable at this level. 25 marks questions are set only on frameworks. Accounting framework, then we go into all the accounting standards, right? And a lot of things have changed, especially in the last 2 to 3 years. The last 2 to 3 years, a lot of standards were changed to plug loopholes in the subject. Companies manipulating standards or manipulating the accounts to plug all the loopholes. Many things were changed. Even last examination, lease standard was introduced to change the old standard because of a lot of manipulation. So you'll be learning the new lease standard, new financial instrument standard. So a lot of new standards have been put in the last 2 years. So if you did your F7 5 years ago, let me tell you, everything is new. But if you did it last exam, then a lot of things are very similar to continue. So, what will we cover under standards? IFRS 13. Right. When you look at the standards, you have IFRS or IAS. IAS is the International Accounting Standard. IFRS is the International Financial Reporting Standard. The older standards are called IAS. The recent standards are all called IFRS. But all of them are international standard. Singapore just takes a standard, blanco the I becomes Singapore FRS. We don't change anything in Singapore. We just take out the I and call it FRS. So everything is the same actually. So they can call it international or Singapore, doesn't matter, but we are only doing the international for the coming exam because ACCA does not offer the Singapore variant anymore. Alright? IFRS 13 is fair value measurement. a new standard introduced 2 years ago called fair value measurement. Right. And fair value measurement teaches you how to find the concept or the word fair value for reporting. Today we will look at that before we finish the lesson. Then we look at some of the important standards that have been always there for non-current asset, which carries at least about 20 to 25% of the paper. We start with those key standards of non-current asset. IAS 16. IAS 16 is all the rules and regulations on property, plant and equipment. How to revalue the plant, how to depreciate, all the rules are inside IAS 16. And then we go into IAS 36, a huge standard, covered very little in lower levels. IAS 36, we look at impairment of assets. Impairment of assets is a key standard. Every exam, he makes sure he tests this. And since last examination, they introduced IFRS 16. IAS 16 and IFRS 16 are different, please understand. IAS 16 is property, plant and equipment. IFRS 16 is a brand new standard just released on leased asset. This has not been implemented yet, but ACCA already changed the standard, asked you to learn the new one. So the old standard is completely removed and you only got to know the new one, IFRS 16. Then after that, IFRS 5. IFRS 5 is held for sale assets. Held for sale assets, which is a special category of assets for treatment of non-current asset. IFRS 5. Then we come into IAS 21, a huge standard, a big standard, and a very important standard on foreign currency. This paper has a lot of issues on foreign currency. Foreign currency in individual accounts and group accounts. And everything you do from today, please keep very clear. Individual account standard can have separate rules. Group account standard can have different rules. The rules need not be the same for individual account and group account, especially currency. Group accounts has a different set of rules. Individual account has a separate. So always check, are you reporting at company level or group level? Group level reporting rules are different from company level reporting. So foreign currency in individual accounts and group accounts. And one of the key things we go through here is exchange differences. How do you report exchange differences, all right, in your accounting? Plus also reporting currency called functional currency versus presentation currencies. How do you select your functional currency for a company? IAS 21. Then we come to one of the biggest standards in the syllabus of P2. IAS 32 and IFRS 9. IAS 32 and IFRS 9 is a huge standard on financial instruments. Right? Financial instruments, you have debt classification, equity classification, recognition of all the financial assets and financial liabilities come under financial instruments. We have to spend about 2.5 to 3 lessons on this standard alone. It is highly technical, plus they take you into a lot of advanced instruments called derivative instruments. How do you report derivatives? And reporting derivative instruments is under IFRS 9. And all this, please take note, are the report things like option, futures. When you go into derivatives like option, futures, forward contracts, how do you report all these instruments, swaps, all this, how do you report in our subject? This paper don't teach you the instrument. They only teach you how to report the instrument correctly. If you want to know how options work, futures work, this paper we can't tell you. There is another part of the syllabus altogether. how an option works, how futures work, how derivatives actually work in the market. For that, please do P4. Understand? Mechanics, I can't tell you here because it's a lot of technical things inside. Mechanics is in P4. Reporting is in. What we are telling you is simply this. You sign an agreement already. You put your signature for an option contract. The minute you sign already means you must report immediately. How do you report when you sign? That's all. How the instrument works, that is not your problem. Understand? And the examiner says, I won't ask anything on mechanics. I will only ask them, the number will be given. They must tell me how to report it. That's all. So, if you come and ask me, how does a swap work? Is it like this? Is it like that? My answer is very simple. Please do P4. Understand? Under option, you have a choice to do P4. Please do. We will tell you for 6 hours what this is all about. Understand? Here, we can't tell you much because it is a very too many things inside plus the timing problem. Then we come into the next issue, which is another key standard. Most of you, I know, left this topic. IAS 12. What is it? Taxation in accounting. Oh God, again. Yes. In our subject, tax is different from tax person's view of tax, right? How a tax person do tax and how accountants do tax are very different. You know that. We have got our own way of handling tax, and we love one tax called deferred tax. So this paper kill you totally on deferred tax. No other tax is examinable in P2 except deferred tax. Calculating corporate tax, finish in F7 already. So they want to give you a number and say, please calculate the tax for the year. Don't worry, it won't happen. Calculating basic tax is done at introductory level. This level is all issues related to reporting the tax at the right time to ensure your profit is true and fair. So we look at taxation in accounts. And taxation in accounts fully covered all the issues related to accountant's tax called what tax? Deferred tax, which tax people will tell you on your face is a total waste of time. Understand? If you ask a tax person about deferred tax, he will tell you what is that. That is because it's not their area. Deferred tax is an accounts person's area because of the timing problem in tax. So we do a lot of deferred tax to adjust the timing of the tax under IAS 12. After IAS 12, we go into another new standard recently introduced, IFRS 15. IFRS 15 covers revenue from contracts. How do you report revenue? They came up with a new standard because revenue was overstated in many companies. And many companies have this habit in revenue, bundle things and sell together. When they start bundling things and sell together as a package, they recognize revenue happily very high wrongly. And that is unethical to overstate revenue. But company says, I sell as a bundle. But when you sell as a bundle, in one bundle you have several contract services. Everything got to be segregated and reported using IFRS what? 15. What do you mean by bundle? Simple what? If you take your handphone contract itself, just look what is inside. You buy a handphone, they tell you handphone free. Is it free? They charge you under the subscription already, right? So when you take a handphone contract, you're paying for the handphone, you're paying for the subscription, right? You're paying for the data, you're paying for so many different things, but all are put into one package. So when they report the revenue, should you look at the revenue based on the whole package or should we segregate the package? IFRS 15 says the right way to report is segregate the package before you report. You can give us a bundle offer, but that is not important when it comes to reporting. We want to report revenue correctly without overstating revenue. So they'll give you very nice scenarios to analyze in the exam. And using the scenario, you apply the standard and show them how to report revenue. So that is IFRS 15. It's a very interesting paper. Only problem is no exam will be very nice. But at the end of the day, you've got to sit for an exam which has got many things inside. And it is a writing paper that requires a lot of analysis when you start writing. IAS 37 is the next key standard. IAS 37 currently has a development which is an exposure draft, ED. ED is an exposure draft. We want to change this standard also. IAS 37, they already recommended some changes, which I'll tell you what they are. What is 37? Provision. 37 covers provision and contingencies. We will cover this as you go through the syllabus. You will see all the big ones coming first. Then we come to some standards which you have not done at lower level at all. They are only kept for P2 level. Alright. One of them is IAS 19. IAS 19 is employee benefit. IAS 19 is employee benefits. How do you account for employee benefits or pension funds? Employee benefit and pension schemes. Employee benefits and pension schemes. In Singapore, if you want to report this IAS 19, there's nothing much to teach because CPF is very easy to report, right? CPF, I don't need one lesson. I only need 5 minutes to teach you CPF, right? But unfortunately, examination, they don't ask you CPF. International paper, they want you to learn pension scheme. And pension schemes are basically company guaranteeing pension when the staff retire. So they got liability, they got assets. You must account for liability, assets, and update pension funds regularly. So there are several schemes that you need to learn under IAS 19. Then we come into IFRS 2. What is IFRS 2? Please take note. This is where you reward your staff with share option. How do you account for share options when you give your staff options as rewards? So IFRS 2 will cover share-based payments. So the last two standards are related to employee remuneration. So IAS 19 and IFRS 2. So these are the key standards for the coming examinations. Please take note. These are the big ones we need to cover in detail in class. Then you have all the small standards. Alright, the small standards examiner guarantee you will not be there every year. Once in a while they throw one inside to shock you, understand? They just release one suddenly after 2 years. When you least expect it, you will see it in front of you. We can't ignore this, we also have to cover it as well. So the big ones I'll spend a lot of time. The smaller ones, I will brush through the important thing and tell you what is important and move on. Alright? Why? Because for examination purposes, they are not critical. But if you want to read, the notes are there. Plus, there will be online classes or lessons on this. You will be given access to the online on the minor standards as well. You can go through that as well. So, what are the minor standards you're going to cover? Right. Under the minor standards, you have a few which you need to know. One of them is IAS 23. IAS 23 is borrowing cost. Interest cost, how do you account for it? Obviously, interest is borrowing cost, which is an expense. But nowadays, you cannot expense all your interest. Especially if the money is borrowed for constructing an asset. When the asset is under construction, you don't earn returns. But you're using the money to construct the asset, it will earn you returns later, right? So by the matching concept, interest costs on asset under construction cannot go to P&L because revenue haven't generated, you're charging expense already, which is not correct. So current practice is interest on any asset under construction, you should capitalize. You cannot, from 2009, you cannot expense it. You have to capitalize all interest on assets under construction. So 23 tells you all these small details about borrowing costs. The other standard which used to be small but slowly getting bigger is IAS 38. IAS 38 is intangible assets, which used to be insignificant before, but now a lot of assets can be recognized in the books because of recent development in the standard. So it is getting bigger in the subject, please. IAS 40 is investment property, which is a different treatment compared to owner-occupied property. Then you have IAS 20, which is treatment of government grants given for buying assets. What do you do with government grants given? Of course, take the grant, but if you take the grant, how do you report the grant? Then you have IFRS 8. IFRS 8 is also a new standard on segment reporting. Segment reporting is basically asking companies to break up their reporting according to geographical segment or business segment. We don't want companies to hide loss-making operation behind profit-making and conceal losses from shareholders. So segment reporting tells you how to report different segments of the business that you have. Then you have IAS 8. IAS 8 and IFRS 8 are not the same, please take note. IAS 8 is changes in accounting policy. How do you change accounting policy and changing estimates? Then you have IAS 10. IAS 10 is a very small standard. Events after the reporting date called post-balance sheet event. What you adjust and what you don't adjust on post-balance sheet events. They are called the post-balance sheet events, which is events that arise during the audit period. Alright, how to report them. And finally, another small standard, IAS 24. IAS 24 is related party transactions. How do you report related party transactions? Right? This is what you will cover in standards fully. A lot of big standards and a few small standards put together will give you a comprehensive coverage of standards, please. And when you finish P2, normally if you've gone through the whole course in P2, your standards when you finish will be very strong because they give you a very good groundwork on standards completely. All the details are covered, and if you update regularly, it is very useful even in your jobs. If you're in an accounting job, it helps a lot. Alright? And once you finish standards, by lecture 11, lecture 12, we can get into part 2 of the syllabus. When you open part 2, only after your standard groundwork is very stable. If not, our group accounts will be in deep trouble. Alright? Because group accounts have got a lot of adjustments related to standards. So we come into part 2 of the syllabus, which is group accounts. That will start from lecture 12 if you see the lesson plan. Got it? And group accounts, when you do this level, alright, you do advanced consolidation. Here we look at advanced consolidation. What will you be doing under consolidation? Basic understanding, as you know from fundamental, is this. You are the holding company. You invest or buy the shares of another company called S1. You bought the shares of another company called S2. And you also buy the shares of company A. S1 you bought 80% of their share. S2 you bought 100% of their share. Company A, you bought 40% of the share. Using basic consolidation understanding, our financial position as the holding company must include S1's asset and liabilities together with S2's assets and liabilities will consolidate together. Because in group accounts, we believe in a concept called, from the framework, single entity concept. If you apply the single entity concept, S1, S2 are different companies, but they are under our direct control. If they are under your direct control, they come into one simple circle, and that circle represents the entity called the group of companies. When you have a group of companies, assets represented in your SOFP or Statement of Financial Position must be the total group assets. Total group asset, total group liability, total reserves, all must come in. So when you do this, we believe in doing the single entity concept. So why must consolidate? It is compulsory to consolidate to imply the single entity concept. And to consolidate subsidiaries, we use IFRS 10. Subsidiaries are consolidated using IFRS 10. IFRS 10 recommends a method called acquisition accounting. So consolidation method we use for subsidiaries is acquisition accounting. 40% you don't have control, you only got significant influence on the company. So they don't come under the single entity concept. So the company with 40%, please take note, is an associate. Anything below 50% is an associate company. An associate company, you cannot combine all their assets and liabilities. We treat it like an investment. But to account for an associate, you do an accounting called equity accounting. And equity accounting is covered by another standard which is IAS 28. IAS 28 is used to do associates. Right? So, this is the fundamental you learn at lower levels. When you take all this understanding, we go into the advanced topics. First topic to open advanced consolidation is what we call as complex groups. Complex groups, from simple groups you go into complex groups. What is complex group? You are the holding company. You have a subsidiary S1. You bought 80% of this company. This company had a lot of idle cash. So you ask S1 to go and buy another company's share called S2. So I buy into S1, S1 buy into S2, S1 bought 70% of S2. If you buy S1, S1 buy S2, is S2 our subsidiary? You are my subsidiary. You bought another subsidiary. So that subsidiary, is it my subsidiary? This is called a sub-subsidiary. Direct or indirect? Indirect holding. They love this in P2. That's the only way they can complicate the whole thing. But if you have your ideas very clear on how to consolidate, they are very easy to consolidate. Should we consolidate S2 into our consolidation process? Answer is yes. Why? Because this is a direct subsidiary and this is an indirect subsidiary. But both are our subsidiary. So in some companies, if you take the financial report and check, their group structure can have arrows running everywhere. The more arrows you see, it becomes highly complex. It is fun to people who buy the company, but it is absolute nightmare for accountants. Why? Branches everywhere means you got to find out relationship, then you got to apply the right rules to do consolidation. So this whole thing is called vertical group. This is what we call a vertical group. And a vertical group you need to understand. And sometimes companies don't want them to know that we hold some company. So you can also do this. Holding company can buy S1. S1 can buy S2. Yes, can happen. So H bought S1 80%. S1 bought S2 only 40%. So if you stop there, S2 becomes an associate. But you can make the associate become a subsidiary. How? You buy some of the shares in S2. So you got indirect control as well as what? Direct control to mask the true control. So I buy 40 here, then here I buy another 30. Total voting power becomes 40% from this company and 30% from our direct leg inside. And this is a D-shaped group. What is a D-shaped group? You have a direct and a indirect leg in the company. And these two structures are examinable because they don't want to complicate things further. You don't want to have the actual ones where branches run everywhere, you can't finish your exam. Actual practice, the style of doing it is similar to the two structures. So examiner says testing will be focused only on two shapes, vertical or D-shape. So this is a vertical group, this is a D-shaped group. So we go into round 2 consolidation. F level teach you round 1, direct investments only. P2 takes you into direct plus indirect inside. Both are covered under complex groups. This is our first topic when we open advanced consolidation. Then we come to another complication, which is in actual practice, how companies do it, is called piecemeal acquisition. What is a piecemeal acquisition? If you remember your lower levels, what we do is this. You buy a company 70%, you buy one shot all the 70, but control is not achieved at one purchase. You buy when the price is right. So, I can buy a company first 30% when the share prices are down. Then, when the share prices go down further, I buy another 40. So, I get my control through piecemeal. First, I buy 30 as an associate. Then I buy another 40. 30 plus 40, my control becomes 70% is a piecemeal acquisition. When you buy like this, how do you treat the 30% purchase? Then how do you treat the 40% purchase in consolidation? Because you don't get your control at one go. At lower levels, when you buy one go. I mean, what? Go in and buy 70. Understand? Actually, you don't do that. You buy little to build control. When you do this, there will be a lot of complications in doing your goodwill, NCIs, and all the other things. So, we look at, you had 10%. 10% is an investment. Then you went and bought another 60% at one go. 60 plus 10 come back to 70% again. Or, you already have 70%. If you have 70%, you buy another 10 to increase your control from the NCI, minority interest. So the minorities sell you 10%, you become a holder of 80% of the shares. This kind of purchases when you buy, how to treat the first purchase, how to treat the second purchase, all you must know what to do. There are specific rules to follow from IFRS 10. We follow the standard and tell you all the rules of consolidating piecemeal. That is topic number 2. Topic number 3 on console, we go into how to consolidate associates. How to consolidate associates and joint arrangements or JV. Joint arrangements are also called JV. This paper doesn't leave out anything. JVs are also tested, joint venture agreements. To do JV arrangement, associates, we follow the rules of IAS 28. Associates, we follow the rules of IAS 28. JV or joint arrangements, we do IFRS 11. The latest standard on JV is IFRS 11. That is the third part of your console. Then we come to part 4. Fourth topic here, at lower levels, you're busy buying and buying and buying. Did you sell anything? Never. Why? Too hard. Come to this level, nothing is hard. Disposal will definitely come in. So you must know how to buy, you must also know how to sell. So you have a subsidy. When you sell off the investment, how do you treat it? Some people are, what is that so difficult? Easy one. Buy at 100 million. Sell at 120 million, profit 20 million. That is company level. This is group level, totally different. Please remember, anything you report from today, your understanding must be company level, how I do it. Group level, how I do it is totally different. So, when you come to group level consolidation, disposal is not so simple, understand? Why is it so difficult? Because when you acquire the company, when you do your consolidation, do you add all the assets and liabilities line by line or not? When you do consolidation, what do? You take their asset, our asset, add together, right? Happily, right on. So when you sell, what happens? When you sell the company, the asset also leave the group. Liabilities also leave the group. So there's so many things to do when you sell a company or sell the investment. So we do disposal of subsidiary. And disposal of subsidiary, please take note. You have a company that you control 80%. You have 80%, you sell off all the 80, you got nothing left. This is too easy, they don't like. Okay? Sell everything is too simple. Your examiner's favorite is relationship changing must be tested in the case study. That means from one relationship to another relationship, how to make it easy. I hold 80, I sell off 40. If I sell off 40, still left 40. So when I started the year, it was a sub-C. When I finish the year, it is a associate. Your examiner loves this kind of relationship. Or you have 80, you sold off 20, left 60. What is the difference between number 2 and number 3? First one, you lost control. Second one, you did not lose control. If you lose control, how do you account for it? If you did not lose control, how do you account for it? Treatment will be totally different. All these options we have to cover when we do disposal, and that will be in lecture 14, 15 when we do. Then topic number 5 on groups is, how to consolidate an overseas subsidiary. How to consolidate an overseas subsidiary. The rules for this comes from IAS 21. And in IAS 21, overseas subsidiaries, we only use one method called the closing rate method to consolidate an overseas subsidiary. And the issue here is this: if you are the Singapore holding company, your currency is Singapore dollar, you have a subsidiary in Thailand, the Thai company's currency is Thai baht, so the P&L and SOFP of the Thai subsidiary is in Thai baht, your P&L and your SOFP is in Sing dollar. Please don't add the two, become Sing baht, understand? No? So what will you do? When you come to consolidation, you must know how to translate all the Thai baht into Sing dollar before you consolidate. To do that, you got to follow the standard. And that's why nowadays there's a big issue in this IAS 21. Functional currency versus presentation currency. So can we do this or not? Ask the Thai company to make life easier. Ask the Thai company to report in Sing dollar. Can we do that? That means what? Force him and tell him, you do Sing dollar, don't ask why, okay? You do Sing dollar. So when I come to consolidation, I can just add easily, you see. So can we do that or not? Is it okay? Before they changed the standard, it was possible. Huh? Then they found many companies were doing this, what? Forcing the other company to report in what? In their currency which is easy to consolidate. So to prevent that, they came up with a criteria to select something called a functional currency. So please take note, nowadays this is possible. You are a Singapore registered company, but you can report in US dollar, nothing wrong. You can be a Thai company, but you report in euro. Can happen. Why? Because of the functional currency concept behind IAS 21. So in IAS 21, you must know how to distinguish something called a what currency? Functional currency. And another currency is called the presentation currency. Functional currency and presentation currency. So a Singapore registered company can be reporting and keeping their books in what currency, please? US. Or a Singapore registered company can be keeping their books in euro, nothing wrong. Perfectly acceptable nowadays under IAS 21 rules. Then we come to topic number 6, which is the last topic of console. And the last topic of console is IAS 7. What is IAS 7? Group cash flow statements. How to prepare group cash flow. Full numbers are tested in all this. Group cash flow statement. And together with this, obviously, we'll be doing SOFP and P&L. So there is also a consolidated one. P&L, we will do consolidated P&L and OCI. What is OCI? Other comprehensive income. So when a 35 marks question is set, is either an SOFP or a P&L, if not a cash flow. Every exam they circulate the three. You can't get P&L, SOFP in one exam, you cannot finish the paper. So the examiner promise you, your first question when you open the paper every exam is either a SOFP consolidation, if not a P&L consolidation, if not a cash flow consolidation. A huge 35 marks will be there facing you. Whichever it is, please do. Last examination, last December was P&L. Consolidation was P&L. Last September was cash flow. So you're here, you know. Right? Last December was P&L. September was cash flow. Coming exam, March, let's see what comes out. After March, we decide for June, okay? Alright? Because it depends on what comes out in March. Normally, the question one you can hit quite easily because you can see the trend quite clearly. So they will never repeat this exam cash flow, next exam also cash flow will never happen, don't worry. So September guaranteed no P&L. Why? December was P&L. December to March won't be P&L. March will either be cash flow or SOFP. So they'll circulate the three around very nicely. And within that P&L SOFP, they will put one of these issues, either complex group, piecemeal, or they will put JV, they can put disposal into the big question. So all the things will integrate very nicely when you do your case study. So when the case study comes out, it won't be just one topic alone. Several things will be fitted inside. So blocks of the syllabus are put in together with standards to create the case study. And the last topic before we finish the syllabus would be group restructuring and reorganization. Group restructuring and reorganization. Why companies do a lot of what? Restructuring. Every business always seems to be restructuring forever, alright? Or reorganizing their companies. Why? And we go through some of the issues there before we finish our syllabus at the end with some recent developments at the end. Alright? And recent developments will be the last part to update you on whatever is happening lately in the subject. And under recent developments, nowadays you have to do integrated reporting, which is going to take a huge part of the new paper called SBR. Alright? You must also know a little bit of IFRS for SMEs. Small and medium enterprise have their own FRS now. Alright? Then they are planning to introduce something called a management commentary together with integrated reporting. Management commentary is you prepare financial reports, you prepare your accounts, you put notes to the accounts, then you give it to the shareholder, and the poor shareholder is financially illiterate, don't know what is going on. At the end of the day, the report that you prepare, you understand, we understand, but the shareholder who's not trained in ACCA don't understand. Therefore, the issue is this: should we explain to the shareholder what has happened in the company? That's why they brought this integrated reporting together with management commentary. That means what? You must explain to the shareholder what we have performed, analyze for them what has happened in the last 1 year, what is your future plans, everything come under management commentary. So that is something we're going to make compulsory if it gets implemented, alright? So these are all under recent development. We will do that at the end when we finish the syllabus. So the whole syllabus requires you to look at only three things: standard, full, thorough knowledge; consolidation, detailed knowledge. Alright? After that, you must also understand recent developments in the subject. So everything is up to date when you finish by the last lesson. So your knowledge must be all the latest things until what is happening today. And I will tell you all the recent things at the end when I finish the syllabus. And today, the basic thing is the exam paper will be like this, please. The current exam paper is like this. Section A. Alright. Section A of the paper, you have a 50 marks case study, 50. Question 1. Compulsory. Alright. 50 marks case study, which is compulsory, and you are expected to perform reasonably well to pass this paper on the 50 marks. That 50 marks case study is in all the P-level papers. So whichever P-level paper you do, first question is always a case study, and the 50 marks, please take note, 35 marks goes to consolidation, guaranteed. In the 50 marks, 35 marks is consolidation. Either consolidated SOFP, consolidated P&L, or cash flow. One of them, 35 marks. The balance 15 marks are issues related to from the case study, they will ask you some issues related to the scenario in front of you. So the 15 marks, they normally like to ask standard issues and ethical issues. They may put some unethical practice inside the case study and ask you what is wrong. Can you recommend the right thing to be done? So we go into ethical practices. Alright? Ethical practice and also standard issues. Standard related issues can come into the 15 marks, please. So most of the examination, 35 marks consolidation, you must do well. This one you must grab as much as you can, because this is where a lot of marks are easy to salvage. Then the writing parts, please write the language correctly, standard language, ethical practice, write whatever relevant answers and get as close as possible to the 15. So at the end of the day, examiner's expectation is case study student must at least get 25 to 30 marks from here. Don't hope to just touch a little bit and hope to pass. If case study is not done well, please come back for the next exam. Understand? Case, they're very clear. Case study must have substantial effort shown. In other words, if the effort is not shown in the case study, very hard to pass P2 already. So this is where a lot of emphasis is given, because there are a lot of basic things inside. Then question 2, question 3 and question 4 come under section B. Right? Section B, you have question 2 and question 3 and question 4. Alright? Section B will not have much calculation. They will have numbers, but simple numbers to highlight accounting problems to you. So 2 and 3 cover standard issues and consolidation issues. They will never ask you, what does this standard say? It's not a memorizing paper, just memorize the standard, come and vomit everything. Issues are tested using scenarios. So they will give you a full company for 125 marks question. This company has this problem, part A, part B, part C. Part A could be related to impairment. Part B could be related to financial instrument. Part C could be related to pension fund. Put the 3 parts into one company and ask you to go through the standard issue, explain what is right treatment and what is wrong treatment. Sometimes the whole question got no number inside at all. So it's fully telling them clearly proper treatment. So it's fully testing treatment in the standard. So standard issues and consolidation issues, normally they are part A, part B, part C, part D. 25 marks split into different parts, where it is good because the risk is low. Even if part A is wrong, I hope part B won't be wrong, because different standard is. Right? It is not each one same standard. They are all different standards. Same thing with question 3, they will have part A, part B, part C. These 2 questions are called the low risk questions. If you know the standard, you can salvage quite a lot of marks here. It is not difficult if you write to the point. What the examiner requires is writing to the point. And the other question is question number 4. Question number 4, 3 questions, you choose 2. Got it? And question 4 is the one which has got a lot of problem, because it is a complete question on one standard or one issue. The whole 25 marks will be on one issue alone. So they won't have A, B, C like this. They will have one particular standard covering total 25 marks. So here they will ask you, what does this standard development tell you? What is wrong with this standard? Why do they want to change the standard? Explain. Then give you a scenario, ask you to use the old treatment, explain how to do this. New treatment, how you do it. So all the new developments are put into question 4. Question 4 is reserved a lot for the new development. It can be a complete standard issues or standard related issue, or it could be a recent development. Or it could be a recent development fully tested. This one is high risk because either you know or you don't know. And luckily, it is a choice. That means what? The low risk questions, most students do 2 and 3. They don't touch 4. Some of them don't even read number 4. Why? They tell me, sir, it's wasting time. I better do what I know very fast. Okay. So 2 and 3 are very safe, but if you know number 4, you can score very well. If you go for scoring, number 4, if you know very well, you can score easily if you hit the right target in answering the question. There's only one particular issue, the whole thing, right? Like leases, when they introduced a new standard, last September, they came up 125 marks fully on leases, asking the question, why the lease standard need to be changed? What is wrong with the old standard? Why do we need the new standard? Explain. Then they give you a scenario. That scenario, if you use the old standard, what will be your answer? If you apply the new standard, how will the answer change? The entire 25 marks was only on lease. If you know the whole thing on lease and you have done the new development, it's full 25. You know or you don't know, right? I hope so, yes. So if you know the lease standard, you can easily do it. So it's one that you can score full or lose full. It goes that way for question 4. And the sad part is, from September 18, this option will not be available anymore. They will take out the option completely and there will only be 2 questions in section B. Alright? And all the paper will be fully compulsory. There will be no more choice in section B from September 18. So you will be the last exam for choice. Okay? So after that, no more choice. So if question 4 style come out, you cannot say I don't want to do, have to do. Why? There is no more choice to drop question 4. So my gut feeling is in the new examination, one question will be similar to this question 2, another one will be like question 4, forcing you to take the issue up without any choice. So they're going to stop all the choices in P-level papers from September 18. So all P-level papers will not have any more choice of question because in strategic decision making you got no choices. Understand? Examiner says, where got such thing, leave this out, don't do. In an actual company running, you got no choice. What? A strategic decision that you take, there's nothing to choose from. That is the decision you have to take and do, right? So like that, they want them to do the whole paper, please take note. So that is the exam paper for the coming June. So after this, there will be no more choice, and please take note, passing the paper is very easy, as I always say, it's one of the easiest papers at P level, understand? All the people don't agree with me. Among P1, P2, P3, P2 always has the highest pass rates. You go and check the history, you don't believe me. The examiner is a very nice person. He set very difficult question. Then come to marking, he's very reasonable, understand? Because he knows he set too high sometimes. So when it comes to marking, he's very reasonable. And people find very surprising because after they say, sure, fail one, very difficult. I say, don't worry, I can pass one, then come out and get 60 marks, 65 marks. I also don't know how I got 65. You are very good, understand? So at the end of the day, it's an easy option, an easy paper to do because 2 things can save you. Write the correct things on the standard because in class I'll be shouting very loud the keywords, understand? Catch the keywords when you come to the lessons, pick up the keywords, when you write answers, throw the keywords inside. When the examiner sees keywords, he gives you marks. So writing on issues are very simple if you catch the language correctly. Don't write simple layman English, understand? Standard has got your own language. Please follow the language given in the standard. That can save a lot of marks. Secondly, the console can save you also a lot of marks. In the 35 marks, good students, normally some of them get very close to 35. Alright? So average about 27 to 28 marks on the console you can easily get if you are a normal person. Okay? If you know what you have done and you are normal in the exam, 27 to 28 marks on the console is very easy to earn. Then the issues you write a little bit here, a little bit there, write some key things correctly, they will give you your passing mark easily. Just keep writing, very important. Don't worry, keep writing, right or wrong, the man on top will decide. Don't sit down there, should I write this, maybe wrong, then how? This kind of feeling should not come. I know what I'm doing, I know this is right, I will write, understand? Keep writing until your hand very painful, sure pass one, understand? Don't stop, keep moving, just keep moving. Something is very hard, look at it, okay, you heard a few keywords, throw inside, relate to the scenario, you will do very well. Most important, don't write the standard isolated without linking to the scenario. You won't get any marks. Huh? The standards say the following, on whole page about standard. Scenario never touch, sure gone. Anything you write on the standard must be linked to the scenario in front of you. That's the key to doing well in P2, which we will train you to write when we do our lessons. I'll tell you how to do it when I do my lessons. It is very different from F7. For those who have done F7 under my classes, you see my approach very different. Why? Because in this paper, you have to do it this way. Alright? So, it is not a difficult paper. Chances of passing are very high, and you are the last batch for the current syllabus. They will push more people through. Understand? They don't want to hold back people and then put the new syllabus, become very messy. So, even if you're on the border, they will push you through. So, take heart and finish it now. Okay? And normally when syllabus are changing, pass rates are much higher. Follow? So, go confidently, do it. Any help you need, don't be shy. Please come and check or send emails. Alright, my email address is there. Alright, on the lecture plan. Alright. Anything you want to check, please be consistent in your work. If you're consistent, I don't see any problem in a big paper like this. Alright? It's only when you leave it for next week, and you never do for next week, understand? The weeks go by very fast, then come to the last 1 month, panic, understand? So keep moving every week. Whatever you don't understand, please come and check. Okay? And it's a very simple paper at the end of the day. So that's how the syllabus requirement is. And your notes are given you book 1. Please take note. This is only book 1, covering up to lecture 7, lecture 8. Alright? There's another book which will be coming for the remaining lectures after lecture 8. Alright? So, if you see your lesson plan, I put out the topics for the lectures until lecture 19. Do you follow? After lecture 19, if you check, you have until lecture 19, is it? Right? After lecture 19, there will be a full revision of P2. If you want to enroll, you can do so. If you're confident enough after the classes you can do on your own, you may also do so. Alright? The choice of coming for the revision is yours. Alright? So at the end of the day, finish it, complete the revision. I guarantee you no problem in this paper. Alright? Confidently I can tell you that because I know what I'm going to do. Okay? Right? So that is the syllabus. That is the first book in front of you, and I'm the teacher. Any question? Anything you want to clarify? Any doubts you want to clarify before I start? Anything I'm not being very clear? I just remind you 2 things. You're only getting what variant is exam? International variant, and June 18 is the last exam for this paper structure. After this, syllabus, 1 or 2 things may change. Paper, there will be no more choice. They'll all become full compulsory. All questions will be compulsory after June 18. Right? So the current paper, you are the last batch to sit for the exam. Okay? Right. So follow the dates given. Follow the dates given in the lesson plan. Alright? And come according to the dates given to you there. So 3rd, 10, 17, all the dates are there. Please follow and come along. Alright? And in the lectures, there will be online lectures to review some important topics. Please take note. Lecture 8 is an online video lecture. Do you follow? Lecture 8 will be online. After I finish financial instrument, I will put an online lecture to review what we have done. That is to reinforce the important standards, please. So, first online lecture is lecture 8 after I finish financial instrument. Then lecture 11, I have put a few of the revenue, segment reporting, related party, all these are the minor standards. All the minor standards I also put into the online lecture. Got it? So lecture 11, which is the online lecture. And then one more online lecture is on lecture 14. And lecture 14 is a complex group review lecture. So don't worry, in the video lecture, we don't do new things inside. It is what you have done in the class just to update you further. So that is the online lecture number 14. After that, the rest are all live lectures. Alright. So these are the only 3 online lectures that you have to go and view after they are uploaded. Alright. And on that note, let me start with my first lesson today. So in your books, if you check, in your notes, if you check, please follow. ACCA detailed syllabus is given to you. Alright. In the first page, you can see corporate reporting. September 2017 to June 18. This is the syllabus given by ACCA in the front. Please check in your notes. That is for you to check whether I'm covering the syllabus properly or not, using the examiner's syllabus in front of you. And then they have a detailed syllabus on page 8, alright? A detailed syllabus on page 8 with a study guide on page 10. Follow? In other words, every part of the syllabus, what you must cover. Every part of the syllabus, what you need to cover is highlighted from page 10 to page 13. Got it? And page 13, I like to draw your attention to current reporting issues. The last thing there, do you see? On page 13, current developments and current reporting issues. So the paper has got a requirement to cover all the current developments and current reporting issues, which is the last part of your syllabus, detail given there. Alright? Then, if you turn to page 15 onwards, you have got format of the exam paper. Follow? Format of the exam paper, page 16. 50 marks, 1 question. 25 marks, 3 questions. Choose 2. Alright? Question 2 will be 3 to 5 FRS examined. Each FRS will be separate from each other. Question 3, 2 to 6 FRS will be examined. When you see FRS is the standard, Singapore we call it FRS, alright? And there will be one big case scenario testing the various standards, alright? And question 4, only one standard will be examined. Most of the time it is a recent development standard. And then you see a table on the following 3 pages. This table is an analysis of the past exam question, whichever standard came out. All the recent standards that came out are all there analyzed from December 07 to September 17. Question 1 was on what? Question 2 was on what? Question 3 was on what? With the company name and the standard tested the year. You can go through and see most of it will have IAS or FRS 21, IAS 12, got it? Alright, most of the standards are the key standards inside there. And then if you turn to page 20, alright, on page 20 you have the full list of standards which are examinable. The full list of standards examinable, you can see clearly IAS 1, conceptual framework, IAS 1, IAS 2, IAS 7, alright, and so on. After the IAS 41, we even do agriculture, understand? What is agriculture? Growing animals and growing plant, how to value. And we report for a farming business, even plants and animals are tested in your B2 level. And they come into different businesses to show you variety in your life, understand? The examiner don't just ask a straightforward business. One exam he asks a sports football club. Another exam he asks a farming business. Do you follow? So they give you different businesses to see your skills in reporting. And he'll tell you below that, you don't need to run a farm to answer this question, full stop. Because I'm not testing you about farming, I'm testing you about standards related to farming business. Same thing when you did the football club, we told a student, you don't need to manage the football club to answer this question. In other words, I'm testing you the standard related to a football club. Whatever standard, you tell me the standard. Don't worry about football club. Alright? So, you got IAS. After IAS, you see all the IFRS. You see all the IFRS. IFRS has gone up to 16. Do you follow? Right? So, these are all the new standards examinable as well. Out of which you'll be starting with IFRS 13 today. Alright? And these are the correct numbers to use when you come to the examination. And one more important thing, people ask me, should I remember and memorize all these numbers? You don't need to memorize. By the end of the course, you will definitely remember. Okay? You come across too many times until it's very hard to forget the number. Sleep also the number will come in your dream. Because you do it too many times until it's very hard to forget and you will not forget. So people ask me, should I write the numbers in the exam? Answer, yes. What if I'm not sure of the number? Don't write the wrong number. Just say, according to the standard. Alright? Assume you know, examiner know. Don't write the wrong number for the wrong thing. That is an unforgivable offense. Got it? So if you're not sure, just say, according to the standard in this area, blah, 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 keep going. But if you write numbers, it shows what? Professional understanding. So therefore, please know the numbers. And then we come into page 23, chapter 1. Chapter 1 brings you into conceptual frameworks. Alright? Accounting framework, key things on framework, we will see today. Alright? You cannot ignore the framework, so we will look at a few things today on the framework. And one of the key things in the framework is, please take note, we will look at topic 1 today. So on that note, let me start with my lessons today. So let me start with this, which most of you have seen from lower level until today. So just to revise very fast and update everyone, in case some of you are very rusty, we will just brush through the framework very fast, some of the key things you need to know. Alright? First thing you should understand is framework versus standards. What is accounting framework and what is accounting standards? Why are there two documents? Alright? What is a framework? A framework, please take note, is a general guideline. To do accounting, you follow lower levels. When you start accounting, what guides you? The rules in accounting: must do double entry, how to find profit, what is income, what is expense, what is asset, liability, equity, all this, you got no standards. You have to follow framework. So framework gives you the basic guideline for the subject. Standards are developed to give you specific rules on different areas of the subject. So therefore, if you want general guideline, you follow the framework. If you want individual area specific rules, look at the standards. So how do I treat an asset? You don't look at the framework, you look at the what? Standard to see treatment. So standard tells you treatment. Framework tells you basic guideline how to do it. And most of the time, standard follows the framework. What the framework say, standard takes the idea and the rules are developed in the standard. So standard rules are developed based on the framework requirement. But sometimes the rules in the standard can conflict with the framework. When the rules conflict, then standard always dominates over the framework. Framework can fail, standard cannot fail. So which is the truth when you do anything in the subject? It is the standards. Standards override the framework whenever there is a conflict. So please understand, framework is actually a general guideline. Framework is a general guideline with definitions. This is a general guideline with definitions. You have all the definitions in accounting inside here, which is why you start covering framework from lower levels like F3 onwards. So definitions and concepts. But we still do it at P2 because there are some very important words you can use in writing your answers. When it comes to writing the part, there's a lot of useful words inside here. Please use the language a lot from the framework. So you got proper definitions which you can get from here, concepts and conventions. All come from the framework. Proper definition, concepts and convention. This is what framework teaches you. So some of the key concepts you must know. I just want to review so that all of us understand these concepts. First concept, when you prepare accounting, we always believe when you prepare accounting, business will be a going concern. You cannot prepare or do reporting without this concept called the going concern concept. What is this concept which is implied in doing reporting is, going concern concept is, when you do reporting, you prepare P&L, prepare your SOFP, all are based on one basic assumption: business will continue forever. If you say business will continue forever, sometimes this becomes a question mark. When will this become a question mark? In your issues, they will ask you things like this. This can become a problem if assets in the company company has a going concern problem. If assets in the company are, come on, participate. You know all this. Lesser than what? Liability. That's where even in audit, you must do a what? A going concern test, right? When you do a going concern test, it's because company's going concern is under question mark. So, you know the basic accounting equation from day one you started the subject is asset equal to liability plus what? Equity. Liability plus equity. So if your asset is 100 million, liability is a 140 million, right? You do your SOFP, you end up with shareholders' equity becoming a what? If you have asset 100 million, liability 140 million, shareholders' equity becomes a negative 40 million. In other words, you're balancing your balance sheet with a negative total. When you end up with a negative total like this, definitely there is a problem with the going concern. Therefore, in a business like this, equity ends up negative. When equity goes into negative territory, we have a problem related to going concern. We call this a going concern issue. In such a situation, the framework says, don't waste time doing things like balance carry down, brought down to next year, take at the value given. Bring everything to net realizable value. Reporting should change from historical cost to net realizable value so that we are ready to close down. So whenever you have a going concern, your reporting will be totally different from a business which is a going concern. So that's why we always test for going concern, and that is the first concept called going concern concept. The second concept which has always been there in the subject is called the historical cost concept. The historical cost concept says accounting must be prepared using historical cost. But the problem is this is a huge question mark nowadays again. For the framework, when it starts failing, what happens is they update the framework. So frameworks are reviewed regularly to update recent development. So if the historical cost concept is followed, you won't have a reliable financial statement. Why? Because of inflation. As inflation comes in, prices start rising. When prices start rising, keeping your assets at historical cost is misleading, right? So if you want a true and fair financial position, should we follow historical cost or not? Right? The question is, it is very hard to get true reporting with historical cost. So nowadays they came up with fair value accounting. So it is not to replace historical cost. Listen, we still follow historical cost, but any asset that change value, you are allowed to bring it to current what value? Fair value. So the fair value, you do a revaluation and create something called a revaluation reserve, so that all assets are brought to current fair value to ensure that reporting is true and fair. So historical cost problem, we overcome, we still use historical cost, but with the rising inflation, please don't say inflation accounting. We don't learn inflation accounting. We don't need inflation accounting in Singapore. Listen carefully. Fair value accounting is not inflation accounting. You only need inflation accounting in countries where inflation goes sky high. If inflation is 200%, 300%, then you don't do historical cost, totally fail. You got to do inflation accounting. Your syllabus, if you check, they don't cover inflation accounting because we assume you are in a country with reasonable inflation, which is either single digit, worst come to us, double digit. Triple digit, 4 digit, all very hard to use this already, and then accounting totally destroyed. Then we have to learn a new accounting called inflation accounting, which is a different way of doing everything. But we don't do that in this paper at all. We still follow what cost? Historical cost. For items which have changed in value, we will do fair value. That's why we teach you IFRS 13. IFRS 13 tell you how to bring assets to current fair value. It tells you what is fair value and you follow the rules. But we are not doing inflation accounting. Inflation accounting should be done in a country like Zimbabwe. Understand? Alright, where your inflation is 1200%. Do you follow? If inflation is 1200%, don't do historical cost. Totally wasting time. Every day prices are changing. Therefore, you must understand the numbers are very big because of 1200% inflation. So you have to do inflation accounting. That is a totally different way of doing accounting there. So when inflation rise, we do fair value. In short, I will put FV. FV means fair value from today. Alright? And if you bring it to fair value, it will increase the reliability of financial statements. So historical costs can be made reliable by bringing assets to what value? Current fair value. And in most standards you will see, they will always teach you how to get the fair value. For every part of reporting, we need fair value. That's why our opening topic is how to do fair value today. Alright? So that will increase reliability of financial statements. Alright? This is what you will learn when you come into fair value later. Third concept, which is used a lot in many standards, is the matching concept, or also called the accrual concept. Third concept is the matching or accruals concept. What is the matching or accruals concept? Please follow. Matching concept or accrual concept, please take note, is to give you a true and aim of bringing this concept is to get a true and fair profit. Right? What does the subject say? If you want to find a true and fair profit, we do not apply accounting on a cash basis. Accounting is never prepared on a cash basis. We always use a basis called accrual basis. What is an accrual basis? In doing reporting, framework tells you to find profit. You don't ask whether something is paid or haven't paid. That is an irrelevant question. Paid or haven't paid doesn't matter. First question you ask is, does it belong to this period or not? If an item belongs to this period, you put it inside irrespective of whether it is paid or unpaid. Because we prepare accounts on what basis? Accrual basis. So, to do true profit, matching concepts say you must match 1 year revenue with, don't care whether it's paid or not paid, match 1 year revenue with 1 year cost. How to get this 1 year revenue correctly? Go into IFRS 15, that teaches you revenue. How to get the true revenue for the period? IFRS 15 will guide you. Take the standard knowledge and that will determine your revenue perfectly without overstating revenue. Don't overstate, don't understate. Revenue must be what you earn for that one period exactly. Collected or not collected doesn't matter. Not collected, you put it under receivable, right? Hello? From day one, I want to make all this very clear, because then suddenly go to study, I tell the student, oh, this one, still not paid, so put it into the P&L. Then they ask me, haven't paid, can put P&L on. My heart drop on the floor. Haven't paid, can go to P&L or not? Yes, must go, not can go, must go. Why? Accounting is not on a cash basis. Accounting is on a accrual basis. Please understand this, and every standard you learn will hit you very hard on this concept. They are built on these concepts. All standards are built on the concept. That's why if you don't know the concept, you wonder why the standard asks you to do so. Then you come to number 4. Fourth concept is another very important concept called separate entity concept. Don't confuse all this. They are all fundamentals. What is a separate entity concept? Come on. All this you know from F3 to F7 to today. Come on. Whichever accounting program you learn, the first thing they tell you is always this. I hope so, right? Separate entity concept say what? When you do business, when you do reporting, you must segregate business and who? Owner. You cannot mix the two. If you mix the two, reporting becomes totally messed up. Especially in a listed company, there are two groups of people. One is the owners. The other one is the business. Who are the owners, please? Owners are shareholders. Please draw a clear line dividing the owners and the business. Anything that you pay for the business, don't confuse with what you pay or collect from the shareholders. The words used are different. Treatment is different when it comes to dealing with shareholders or business-related payments. If you pay anything for business, alright, salary pay is what? Expense. Agree? But when you pay some money to your shareholders, please don't say expense, you're insulting them. Anything you pay to the shareholder, you cannot use the word expense. Why? Then you're telling shareholder you're an expense to the company. You pay shareholder, you don't say expense, you say what? Dividend. Dividend is shareholder. Expenses are business. So, paying money is expenses, collecting money is income. But if shareholder give you money, you don't say income, you say equity, right? So anything to do with shareholder, separate entity concept say, shareholder introduce money into the business is what please? Is equity increase. We pay shareholders returns every year, that is called what please? Dividends. And dividends will lead to equity what? Decrease. Yes. This is how you differentiate the two. Don't mix up the two. Keep concepts very clear. And separate entity concept says anything to do with shareholder should be handled under one word called equity only. You cannot bring it into business and confuse everything. A director in a company, this is how you must see it. A director in a company is running a management job. For running the management job, you are paying him a salary. If the director happens to be a shareholder, you must be very clear. Payment for management services, salary. But for his shareholding, you pay him dividend. Don't put together director's expense. Why? Salary is separate, dividend is separate. They are two different issues. Don't mix the two. So, payment, equity decrease, expenses, income, please take note, are separate from dividends. Alright? Why is it like this? Because of a concept called separate entity concept. Then, number 5, only 5 key concepts. 5th concept is what we call as prudence concept. Heard of it? Heard of it? Accountants are trained to handle or report prudently. What is reporting prudently? When you do reporting, anything you do, when you report, you have to apply something called the rule of conservatism. You have to be conservative. You are trained to be conservative or pessimistic in your approach when you declare profits in a company. In simple English, it is all right whenever you're not sure of something, take the course of action which will understate profit. Understating profit is perfectly all right. Overstating profit is illegal. Understand? Don't choose a course of action that will overstate profit. Overstating profit is misleading shareholders. So any good news, don't say too early until you really get the money in your hand. Bad news, confirm going to happen, can say early can say. Okay? So because you are prudent. So we do provision. Listen, you do provision. IAS 37. Why you do provision? Provisions are made for losses. You don't make provision for gain. Understand? 37 don't teach you how to make provision for a gain. Provisions are only done for future what? Losses. Why is it like that? Because we are prudent. And conservatism or pessimism say anything you do, ultimately, please take note, it is okay to choose a course of action which will understate profit. Of course, you want a true and fair profit, but if you are not sure of what to do with a certain item, choose the course of action which will understate profit. Never overstate profit. This is the key rule in doing what concept is? Prudence concept. Alright? So these are the 5 key concepts when you do accounting, please. All come from the framework. Then from here, every statement that you prepare, whenever you do your financial statement, you spend a lot of money and time. So you want to produce a good quality statement. To prepare financial statements or financial report, it must possess or have some qualitative characteristics. Alright? It must have some qualitative characteristics, and we are looking at qualitative characteristics of financial statements. What are these qualitative characteristics of financial statement? A good quality financial statement must satisfy two important criteria. What are these two criteria? Please follow. Any good quality financial statement must have, number one, relevance. It must be relevant. And number two, it must be reliable. We want relevance and we want reliability. Alright? A good quality statement will give you relevance and reliability. What is relevance? Relevance means by looking at a financial statement, future investors and existing shareholders can make decisions on your company with the statement that you prepare, because they know that the numbers you give there are relevant and reliable. So in simple English, good quality statements are not manipulated. You don't manipulate to overstate your profits because you want more bonus, understand? Alright? If something is not right, if something is bad, report the true position. If business is bad, tell your shareholder business is bad. Don't try to artificially boost the profit and show what business is doing very well. So it is very easy to manipulate, which you will see as you go through the syllabus, understand? Indirectly we also teach you how to manipulate. But we got to tell you what is wrong to teach you what is right. So we got no choice, understand? So where you can manipulate, how companies manipulate, we can tell you a lot of areas you can manipulate. Don't do any of them which I'm going to teach you, understand? Do what I tell you is ethical only. The manipulation we tell you because we must tell you what is wrong to show you what is right. I hope you understand, got it? Because in the exam they will tell you the wrong things. You must tell them the right things. So your job is to understand the standard and apply it. So relevant means what? Relevant means investors can make decisions. Relevant means if you prepare proper quality financial statement, investors can make decisions on company's future. Investors can make decision on company's future. Company's future by referring to financial statements. By referring to financial statements. Because what you have published are all the relevant things for them to know. If they want more detail, they can look at the notes to the accounts, right? Using all this information, they are able to make up their mind whether they should buy more shares in your company or sell off the shares in your company. An investor can only do that if you give them relevant what? Information. A good quality statement is able to give the relevant information, which brings you to a very important word called reliability. Reliability comes from an accountant's attitude called faithful representation. Reliability can only be achieved with faithful representation. Please use some of these words when you write on ethical issues. And faithful representation says you should follow the following things if you want to report ethically. Every statement, when you publish, good quality statements will have substance reported and not the legal form. We call this substance over what, please? Over legal form. What is substance over legal form? Basically, when you do any reporting, don't worry about legal agreements. We look only at the substance of the transaction. Many companies want to hide loan, because if you put loan on the SOFP, your gearing becomes very high, company looks very unstable. So a company wants to borrow money, but they don't want to call it loan. Can teach you the first manipulation of your life. Are you ready? A company wants to borrow money, but they don't want to call it loan. If you don't want to call it loan, what can you call it? So you go to the bank, have an agreement with the bank called sale and what? Repurchase agreement. A sale and repurchase, you tell the bank, I give you my goods in the warehouse, but I'll keep the goods for you. You just sign an agreement. You lend me $10 million. Alright? I don't want to call it loan. We will sign an agreement separately, legal document. Alright? I will sell the goods to you today. $10 million goods, I sell it to you for 12 million. So you lend me 12 million. When I repay you, I will pay you 15 million with interest. So today I sell, in my book it is what? Sales. When I repay you, I buy back the goods from you, is what? Purchases. Sales hit, P&L. Purchases hit, P&L. Loan disappear for 5 years. Interest disappear for 5 years. Company look very stable. That is called off-balance sheet financing. Off-balance sheet financing is unethical because it is legal form applied wrongly. So you cannot do things like this to cheat your shareholder. And don't ever say all these are acceptable in your exam, you will fail immediately. Anything ethical, please write. Even if you're not happy with what you write, please write. Why? If you say anything which you feel is okay, never mind, then the examiner will say, what okay? Your ethics are questionable. So, substance over legal form, we don't want companies to have off-balance sheet financing. So, report substance, don't report legal form. That's why they changed the lease standard. Why? In lease, you got 2 leases, right? Even today in Singapore, you got 2 leases, right? One is operating lease, the other one is what? Finance lease. Why did they change the standard? Because the old standard, which is FRS 17 in Singapore, alright, companies are manipulating this operating lease, finance lease. If you call a lease as finance lease, then you must recognize asset, you must recognize liability. So what happens when you recognize a liability, gearing becomes very poor, interest goes to P&L, expenses become higher. So most companies don't want to call, even though the agreement is a finance lease, they prefer to call it operating lease. Because they say a lease means I pay rental one. So charge as a rental to P&L. If you charge leases as a rental to P&L, but you keep the asset for the entire life with you, understand? The asset is there in your company for the entire life, but you call it a one lease? Operating lease. At the end of the day, if you call it operating lease, there's no liability on the balance sheet, right? Why? Every year you put it as expenses. So liability disappear, interest disappear, company appears stable for the 5 years. And they changed the lease agreement because a lot of companies were calling finance lease as what? As operating lease and manipulating the statement successfully. And today you see the financial statement, company, okay, what, very stable. So you buy another 1 million share. You bought 1 million share, company was very stable. 2 weeks later, company going to close down because cannot pay their liability. Why? Because they never show you all the liability on the balance sheet. They hide the balance sheet, or they hide the liability from the balance sheet, which is called off. So what they do now, they change the lease standard, force the company to what? Report all the leases on balance sheet. So all the leases which are long term, compulsory to put as asset and liability. You cannot run away. Standard got no more testing, operating lease, finance lease, all these are thrown away. So they change the standard to prevent manipulation. Again, the objective in the standard is to achieve faithful representation. So standards are brought in to achieve these objectives. 2, to have faithful representation, you must have materiality. Reporting must look at things which are material. In simple English, good quality statements will focus on the big things rather than small detail. We want materiality in reporting. Thirdly, please take note, good reporting must be complete. Good reporting must be complete and free from error. What do you mean by this? When you prepare financial statement, don't finish your statement and publish your accounts by putting there suspense account 20 million. Understand? No? Then the shareholder come to the AGM, why suspense account 20 million? Oh, I was trying to balance, no time, cannot balance. So I force it to balance and next year I'll tell you why. At the end of the day, when you publish accounts, the document that you publish must be perfect to the last cent, without any errors. So complete and free from error. And number 4, if it is a reliable statement, you have prepared the statement by being a neutral person. In other words, in preparing financial statements, you should be neutral and not biased. Look at it this way. You are appointed as a financial controller in a company to protect the rights of who? Shareholder. So if management tell you, can we change this? Can we, directors have a crooked mind. Can we change this to make the results better? Standard say can, you say can. Standard says no. You put your foot down and say no. You cannot be biased towards management and say, yeah, should be, let me try possible. Then you try possible, everything possible, then end up what? Totally biased towards management, and you don't reflect the true position to your shareholders. You are there to protect whose interests? Shareholders' interests, because that is called faithful representation. So if you satisfy all this, your accounts become reliable with good quality. This is what you call qualitative characteristics. In your notes, just to tell you where you can read all this, I'll just summarize for you. Page 26, follow. Page 26, you have qualitative characteristics. The concepts I didn't put inside because I thought it was too basic, but if you want, you can put it down, okay? The concepts are not there because I believe most of you know it when you come to P2 level. But qualitative characteristics, the keywords are all inside from page 26 to page 27. And at the end of page 27, please mark the definitions of the elements in financial statement. Okay, what are elements in financial statements? Please take note. What do we have in financial statements? What are the proper definitions? What are the proper definitions of items in the financial statement? These are called elements of financial statement. Please learn the proper definition, because if you write issues, you should follow some of these definitions. So the first keyword in doing reporting is asset. Right? How do you define an asset? An examiner gets very upset when the English is not correct. Please take note. Some students write to the examiner, asset is anything the business owns. What the hell are you defining? Then what is liability? Liability is anything the business owes. Oh my God, that is called cheapskate definition. What is the proper framework definition? Examiner said they should be writing framework, not telling me general English, own, owe. All these are okay to talk, not to write. So what is an asset? Asset by definition in accounting is 3 keywords in the definition. Resource controlled by the company. First word, it is a resource controlled by the enterprise or controlled by the company. You must have control over an asset. Resource controlled by entity or company. Second keyword, it is a result of past events. Asset comes as a result of past events. So you bought an asset or you constructed an asset, it is a past event. Thirdly, very important word for asset is future economic benefit will flow to the company. Anything that has got these 3 things satisfied is an asset. Even if one of the 3 words is not satisfied, it is not an asset by our definition. So it is a resource controlled by the entity due to past event from which future economic benefit will flow to the company. Future economic benefit will flow to the company. This is what the definition says. Asset. And 2, after asset, you must know how to define a liability. Because when they bring up standards, they make sure that the standard satisfies this definition, especially intangible asset. Under the old standards, a lot of things were not recognized as intangible asset. Then this definition came in for asset. Using this new definition, a lot of intangible assets can be recognized now. A brand is if you look at the 1980s and 1990s, brand was never an asset, But today, brand is a very important asset. Why is brand an asset? Because brand is controlled by who? Controlled by the company. 2, it is a result of your effort building up the brand. Thirdly, the brand generates future economic benefit. So all brands can be recognized as a what? As an intangible asset because it satisfies the definition in the framework. So standard follows framework definition to recognize all this. Same thing with liability. Is provision a liability? Yes. Why? Because you are satisfying the following words. What are the words? Liability definition say, any liability is an obligation. Any liability is an obligation to transfer. You have a commitment or obligation to transfer economic benefit. Transfer economic benefit. Again, liability is a result of past what? Past event. And thirdly, very important, liability will result in outflow of future, outflow of economic resources. Future outflow of economic resources, it is a liability. That's how we define liability. 3 keywords. Third important word in your life is equity. To do higher levels, 5 words can determine a lot of things in your subject. In other words, these are the 5 keywords for you to carry on. Understand? Alright? No need to get into very detailed double entry and all that. The 5 keywords are what you must know. Based on the 5 keywords, you develop your double entry and learn the logic correctly. So, we come into equity. What is equity? Equity is a very simple definition. Residual of asset less liability. Full stop. Why? No more English to put in. So residual means balance. Balance of what please? Asset less liability. Asset less liability is always what? Equity. Or whatever belongs to the owner. So if you do that, number 4, we have income. Income definitions. Framework changed the definition. And they brought the new definitions into the subject. What is income? Income, by definition, is any increase in economic benefits. And don't use, this is what I mean, is that our subject as a language. The language must be proper when you write. Because people say, see the English or not, future economic benefit will flow to the company. Some students write, money coming into the company. What? It is same meaning or not? Yes. But you don't say money coming into the company. Then this one say outflow of economy. You say money paid to people we owe. What is it? You don't write like this at exam. You understand? At the P2 level, your writing must show some class. Understand? Meaning is the same, but the language style is very crude. Understand? The subject has its own professional language. Please write properly. Actually, economic resources, economic benefit, all refer to what? Money. But don't say money collected, money paid. All that are not correct. The language must follow what the framework tells you. So, income is increase in economic benefit. To put it bluntly, money flowing into the company. Understand? Alright? But increase in economic benefit can also be due to increase in asset. Whenever there's an increase in asset, it is income. Or it could be a decrease in what? Liability. Increase in asset is an income. Decrease in asset is a liability. You can check and see. All increases in assets are income. Decreases in liability are also income. Simple understanding. Sales. Look at your double entry logic, you will know why. Sales. Sales, for your information, double entry is sales double entry is not to insult you, just to make sure you understand. Why the definition like this? People ask me, how can asset go up, become income? Has to. Yes, what's the double entry for sales? Debit your cash. If it's cash sales, you debit your cash, credit your sales, right? So income is sales, cash is asset, right? So whenever you have income, asset go up what? What if it's credit sales? Okay, credit sales double entry. Debit, receivable, credit, sales. Receivable is also asset, right? Right? Then liability. Somebody you owe money, follow? And that person never chased you, he forgot about it. You also never pay. And eventually the person died, no need to pay. Okay? Follow? For example. So if you don't pay the liability, then what is it? If you don't pay the liability, what is it? Whatever liability you had, You debit your liability, you credit your unexpected income. Yes? Yes or no? Why? Again, liability go up or go down? Liability go down is an income, right? So every time you have movements like this, they are all income. So income will lead to increase in profit. Income will lead to, any income also will lead to increase in profit. Then we have number 5. What is number 5? 5 is expense. 5 is expense. What is expense? Expense by definition is, yes please, the opposite of income. What is it? Decrease in economic benefit is an expense, or it could be a decrease in asset, or it could be an increase in liability. Whatever the movement is, this will lead to a fall in profit. Bringing expense will lead to a fall in profit. And the basic principle when you do the framework is clearly stated: income less expenses. Income less expenses will give you profit or loss. Obviously, income greater than expense is a profit. Expense more, it is a loss. Therefore, if you apply the concepts of debit credit, alright, just to bring everything so that it's easier to see the logic of debit credit. Asset in accounting is always a what? Debit balance, yes. Assets are debit. Liabilities are, is all assumed knowledge from lower levels. Liabilities are credit, yes or no? Equity is credit provided business is a going concern. If business is not a going concern, equity become debit. Yes, so equity should be a credit. So debit equal credit. Debit equal credit because asset equal total debit equal total credit because asset equal liability plus equity. Yeah. Framework, yes. So debit equal credit, which brings us into income and expense. Income in accounting is always a credit. Expense is a debit. If income is a credit, expense is a debit, profit must be a credit. I don't have problem with all this later in my life, you understand? So let's clear this today. You're not sure, tell me now. Then it's easier for us to develop the standard. Because when I go there and say one or two things, people look at me, what are you saying? How can it be like that? It's like that from day one. Hello. Income more than expense is called profit. You know that, right? So income is a what? Income more means income, profit is a what? Credit. If profit is a credit, loss is a what? Loss is a debit. Then if I ask you the question another way, why is profit a credit? Why is profit a credit?
Income is
of course, profit is a credit because income is less than expense. Agreed. So what is profit? Is it an asset or is it a liability? It is an asset. You die straight. Understand? No? Why? Asset is debit, right?
It is.
Asset is debit, right?
Equity.
If asset is debit, profit is a credit. How can you say profit is an asset? Don't use this kind of words wrongly from today. Profit is not an asset. Listen carefully. Profit is not an asset. You will never be an asset until you finish your P2. Understand? No? Profit is not an asset. Profit is not an asset. Can you please get this very clear? Profit is a credit because it is a
Equity.
liability, or even worse. If you say profit is a liability, then loss is a what? If you say profit is a liability, then loss is a what? Asset. So next time you got no asset, what to do? If your company want more asset, what must you do? Make more losses. Why? Loss is an asset, what? Right? So you don't use the word, this is my point, don't use the word asset liability whenever you do profit or loss. Profit got nothing to do with asset or liability. Then what is profit? Why is it a credit? Because profit is a credit, because from day one you know profit belongs to who? By law, separate entity concept, profit belongs to who? Shareholder. Anything with shareholder, you must say one word in your life. What is it? Equity. So why is profit a credit? Profit is a credit because it belongs to shareholder. It increases shareholder equity. And equity is already a credit. If you make profit, equity go higher. Yes or no? So you add to the equity, you credit equity, right? Loss is a debit because it reduces shareholder equity. So anything on profit or loss, don't use the word asset or liability. They are all related to one word only, equity. So profit is a credit because it increases equity. Loss is a debit because it decreases equity. That is the concept behind profit and loss. So the 5 definitions, you cannot forget. Anywhere you do your writing are these 5 important definitions. And the debit credit concept goes like this. So if asset go up, you debit some more. If an asset go down, you please do your double entries when you come to consolidation. All these are assumed to be known. Asset go up, you debit some more. Asset go down, you credit the asset. If liability go up, you credit the liability. Go down, you debit the liability. Just keep on moving like that very fast. Alright, that will help you understand your double entries very fast, please. If you know that, these are the key elements in the financial statement. So the ultimate equation that you must know is asset equal to what, please? Asset equal to, framework comes up with this very clearly. Asset is equal to equity plus what?
Liabilities.
Equity plus liabilities. This is the key to understanding our reporting paper, please. Okay, come, take a short 5 before we start on the next part, which is measurement. Quickly.
This is ground.